The travel sector has been really whipsawed by the 9-week-long war. And after the bell today, we're going to get some detail on just how much it might be affecting tourism and travel when Expedia and Airbnb report quarterly earnings. And right now, both are in the green at the moment. And we've got Expedia up 2.5%, Airbnb up just under 1%. Investors will be looking for perhaps more granularity on when it comes to how consumers are or aren't spending on vacations and work trips amid the tensions in the Middle East. Look no further than American air carriers, though. Since the war began in late February, it's really been rough and tumble, quite a roller coaster ride. Thanks to the soaring price of jet fuel, we've got Alaska Air down 21%. That's sort of the downward leader there since the war began. Jet fuel prices have doubled. And government data show that U.S. airlines spent more than $5 billion on fuel. That's just for the month of March. And that's up 30% from a year earlier. And yet, the S&P 500 is just off record highs. So if the market is projecting well beyond the conflict, should investors be doing the same? And if so, what buys should they be making? Let's get right to the floor show. Joining me now, UBS Managing Director and Senior Portfolio Manager, Jason Katz. Should they?
You have to watch what the consumer actually does, not what they say. And if you look in the rearview mirror this quarter, wow, I mean 17% year-over-year growth. So the consumer has been voting with their feet and spending. That being said, with this boy who cried wolf scenario with the Strait of Hormuz and negotiations, if energy stays elevated for a prolonged period of time, once we get past some of the benefits of the big, beautiful bill and the effective tax cut that many low-end consumers have gotten, they're going to take a hard look in the mirror and say, maybe I shouldn't take that flight. Maybe I shouldn't buy that incremental pair of sneakers. So the next few weeks are absolutely critical in seeing these straits open and getting this past us. I
mean, quarter to date, the Nasdaq's up something like 19%. It's really hard to be concerned by a day where we see a quick reversal. So again, and I think it was yesterday when we had that huge rally where the Nasdaq was up 512 points. I said, we've seen this movie before. Who knows if this is going to last? And sure enough, here we are. We see a retracement. But that said, do you feel that the time to look forward to is what the market in the aggregate is doing? And that is saying this thing's going to end at some point. And we have a great, strong move in everything AI.
Yeah, it's so untenable what's happening there for all parties involved that the market has voted with its feet saying we will get past this. But it's a very narrow market. You know, 22% of the companies have beaten the benchmark in the S&P.
That's it?
That's it. And that's the worst underperformance for the rest of the companies over 30 years. So we need to see a broadening of the market and not just rely on this AI enthusiasm. And there's good reason to be enthusiastic.
Oh, yeah. I mean, you look at what's been happening with the stocks hitting a record high, and suddenly we're seeing software rear its head once again. But when you say that we need to see that happen, that doesn't mean we will see a broadening of the market. But let's just say it is coming. We don't know that, but let's say it is coming. What to buy first?
Well, first, let me take a step back and say I believe it will come to fruition.
Okay.
We have unemployment that's really reasonable, GDP growing above trend. We have an obligatory cut coming for the Fed. I do think the straits will be open in a matter of time. And so I do think we're going to continue to see earnings growth that for the year could be north of 15%, and some are even calling for 20%. So what do you buy in that world? You buy things that were left behind whose valuations are reasonable. Financials, energy, infrastructure through the way of industrials, healthcare. These are all sectors where, from a valuation perspective, you're buying things 25% less than the S&P, and yet that cohort is going to grow earnings at 16%. There's a disconnect.
I remember in January, a lot of people came on. I can't remember if you were one of them, but they said, healthcare. Healthcare is finally going to do well. I mean, the biotech index, the XBI, it's interesting to look at something like that where you would think, these are the next best things that are coming out. If you think that there are developments in AI, there are developments in biotech. And yet it's kind of meandered. It's up about 9% year to date, but still.
Relatively speaking, it clearly has underperformed. But you have to think about the industries that AI really will move the needle. And my clients are in the medical world are like jumping out of their skin. They're so excited about what they see coming down the path. So you have defensive growth attributes, and you have this whole longevity theme. So it's hard to get excited about healthcare, but really, if you look at the valuations and the disconnect and the AI catalyst, I think you need to consider having some money there.
Oh, yeah, longevity. If I hear one more person say, I'm going to do cryogenics and freeze my head, and then okay, no thanks.
Just jump in a cold plunge. You'll be fine.
Cold plunge. Thank you, Jason.
Thank you.
Great to have you. All right, Peloton pedaling to gains after the fitness company's latest results.